Howdy, hot shots. It's the Dividend Daddy, your favorite, not a financial advisor with not financial advice. And today we are talking all things GDXY. Okay, so we know we've had a ton of inflation, especially over the last 5 years, but going back until to where they came off the gold standard. Okay, we have had nothing but a declining value in the dollar. Obviously, there's short blips here and there where the dollar goes up in value. Most of the time, that is in relation to other world currencies, which are also being inflated. So we don't see any kind of consistent time period where the dollar goes up in value over time. In fact, their goal isn't even to keep the dollar going up in value. It's to make sure that the dollar goes down in value. Now, I don't like this plan because it's a hidden tax. People who are savers, people who are being prudent with their money, people who don't borrow a lot of money are the ones that get hurt the most by a declining dollar value. But that's the way the system is set up. In fact, if we took every dollar in existence and paid back the Fed, we still wouldn't be able to pay off our debt because we would still owe interest. So the dollar was doomed from the very beginning of the creation of the Fed. But that doesn't mean that we don't still use it to buy our goods, that we don't still calculate our worth based in dollars, because even though it isn't perfect, it is backed by the full faith and credit of the United States and is enforceable by the United States military. In fact, I think that's why we go to war often. People will say that we go to war over oil. People will say that we go to war over natural resources. I don't actually believe that to be the case. The countries that we go to war in, where they have a lot of oil, we typically will give that oil back to the country even after we have conquered that region. Yes, a lot of times the contractors get rich because they're the ones processing it and getting it out of the ground. But the reality is, I think we are going to war to make sure that those countries are continuously trading oil in the dollar. That is because of the petrodollar. The petrodollar means that oil worldwide was traded in the dollar. That has been slipping recently, which means even more inflation may be on the horizon. When countries had to buy oil in the dollar, or the petrodollar, they had to have a lot of dollars in reserve in order to get their country's energy requirements paid for. If, like BRICS is doing, where they're trading outside of the dollar, if it moves away from dollar-denominated oil trades, then what you'll see is less countries have to have dollars in reserve, and those dollars come flooding back to our country, buying up our real estate and buying up our stocks and causing even more inflation because there's more dollars chasing fewer goods. That means that inflation is here to stay. We could go through a short period of deflation, but the reality is we've heard the Fed chairman say that they would rather drop helicopter money, just pour money on the country, than go through a deflationary or stagflationary period. So they will not let that last. In fact, we are still in an everything bubble, and yet they're talking about rate cuts because they're worried about the housing market. Well, the housing market is in a bubble. It is in a bubble historically speaking. However, they don't want to see it go down, and they don't want to see us go through a deflationary period because that means negative growth. That means higher rates because people will be more tight with their money and they won't want to lend it out. Higher rates means that the country has to pay a higher interest payments on their debts, and we just can't afford it. So they would rather inflate away the debt. You've heard about these $16 trillion in national debt. Whenever we have lower rates, they're able to issue bonds at lower rates, which means they pay less and less for that debt. If we inflate the currency by having those lower rates, then that means that it's easier for banks to get money, which means it's easier to lend out the money. And that means there's more dollars created into existence, because a lot of people think that the government creates dollars, but they really don't. Inflation might start with governmental policy and with Fed policy, but really the inflation is at your local bank, because anytime they lend money to you, they are doing so with more money than they have in reserves. And then that creates dollars out of thin air and creates currency. So every time somebody gets a loan, That is inflationary. When they pay off the loan, it's deflationary. Well, what have we seen to the value of silver and gold in inflationary periods? It goes up because it is a store of value. If there is a stock market crash, a lot of times gold and silver will go down as well because people are just creating a flight to safety. And so they see, bonds as being safe, and they'll move money into bonds. There's not a lot of big money managers that will invest directly in silver and gold because they can't make an income off of it. They do make an income by shorting silver and gold contracts, paper contracts. And so there is a lot of short interest in silver and gold, which further suppresses the price. But what this creates is an atmosphere where it would be easy for silver and gold to explode in price. They work very hard to keep that from happening because when it does happen, it further destroys faith in the US dollar, which leads to even more inflation, and they don't want hyperinflation. But if you saw a video I saw a video, I don't know if you've seen the video, I saw a video from a guy who went to the Walmart app and he hit reorder. And he had placed a grocery order in like 2019. And a few years later, he goes to place the same order. In 2019, his order was $50-something. And when he went to replace the order, just reorder all items, it was like $350. And so the low numbers that they quote us for what our inflation has been, even when it was getting high in this post-COVID era, they still underestimate the inflation. They still underestimate how much extra it's costing us to live. And they do so through means that aren't obvious to you and I. Like they will exclude energy costs from the inflation rate. They'll exclude housing costs from the inflation rate, and they'll say, well, those things are too variable, so we can't count them, but we still need them to live. So inflation is actually a lot bigger than what they quote. And that inflation causes gold and silver to go up in value. And as I mentioned with the big money managers, it's very hard to get an income off of gold and silver if you're holding the physical metals or if you're holding the SLV ETF or something of that nature where it's just stagnant and it doesn't generate an income. But YieldMax has their gold miners, VanEck Gold Miners Income Strategy Fund, I think is what it's called. And it writes synthetic call positions on GDX, which has been performing quite well. So they will typically, from what I understand, they will buy in the money calls and then they will sell out of the money calls and they'll sell calendar spreads and they'll generate income that way. And the income is huge. Okay, I own some GDXY. I don't own as much as I wish I owned. It has been performing quite well for me. It's got an average annual return since inception of over 30%. It's got a yield right now of 44%, and it pays monthly. So it's not a weekly payer, but it's a monthly payer. So I've got a couple of things on my Best Western Rewards notepad here that says if you want to double your money with drip on this monthly paying GDXY ETF, it would take you just under 19 months. So less than 2 years to double your money. And this is just assuming that the price stays the same and the yield stays the same. My price has actually been going up since I bought it, but it does have a rocky past. Now, I anticipate gold to continue to perform well in the near future. Obviously, it won't be a straight line up, but I do expect it to continue to go up. And so the GDX will probably continue to go up along with that. And so I am anticipating the performance of this fund to do well into the future. Now, you are much like when we talk about Ulti, you are not going to capture all of the upward momentum in GDX by owning GDXY because your returns are capped by the calls that are sold. So you are going to get some exposure to the performance of GDX and the upward momentum of GDX, but you are not going to get all of it. And what you are getting is you're getting additional income from the calls that they sell. That could mean that it performs better than GDX in some periods. It could mean that it performs worse than GDX in some periods. Okay, but 44% is an absolute monstrosity of a yield. And so just under 19 months to double your money if the price stays the same and the yield stays the same. If you want to withdraw all of your money, all of the distributions that you get every month, if you want to withdraw them and put them in other investments or use them to live on or reinvest a portion of them or something like that. But if you withdraw all of it, it'll take you just under 27 months before you get 100% of your money back out. And then you're playing with house money, as we like to say. So if you were able to get 100% of your money back out in 27 months, it means in just over 2 years, you're basically got free money sitting in the fund. And you've had that huge income that you could utilize to live or put in other investments, and hopefully it's grown as well. I wanted to see how much it would take to get $5,000 a month out of GDXY if the price stays the same and the yield stays the same. And so I did the math, and it's right around $136,000. You could get $5,000 every month in income. Okay, now obviously that's not guaranteed, and you could wind up losing money, but if the yield stays the same and the price stays the same, that's a very small capital amount in order to get that huge income. I like having GDXY in addition to Alti because I feel like it's a little bit of a hedge. If gold is going up but stocks are going down, now I've got a little bit of good performance to help offset my bad performance. I actually don't have enough. I only have under $3,000 worth of GDXY, and I need to pump those numbers up. Those are rookie numbers. But with $5,000 a month, if I could get up to $136,000 in GDXY, do you know how many Pall Malls and bottles of cheap vodka me and Gag could buy?